Welcome, everyone, to the High Weekly Research Seminar. I'm Dan Ho. I'm a professor here at Stanford, also Associate Director at Stanford High, and I also direct the Stanford Reg Lab. Today, I'm here with my colleague, Jacob Goldin, who is the Richard M. Lipton Professor of Tax Law at the University of Chicago, as well as a research professor at the American Bar Foundation. Previously, he was a colleague here at Stanford. In today's seminar, we're going to discuss a collaboration with the Internal Revenue Service and the Treasury Department on using artificial intelligence to reshape a core function of government, collecting revenue. Before we begin the presentation, a few logistics. Please feel free to ask your questions through Slido. The link will appear shortly in the chat. And we'll be choosing questions from Slido after the presentation, which will run about 40 minutes. So we'll have some time really to answer any questions you might have. Slido has a nice upvote feature so that we can choose questions all y'all are most interested in. Closed captioning has been enabled for this webinar. So please click on the CC feature on your Zoom screen to show captions throughout the hour. And with those logistics out of the way, I'm going to go ahead and share my screen, and we'll go ahead and get started. All right. So this title of this talk is Modernizing Tax Administration. It's been a large team effort with contributions by many individuals that we'll sort of highlight throughout the talk. I am obliged to issue one disclaimer, which is that all views and opinions expressed in this presentation are our own and not any of our co-authors, nor the Internal Revenue Service, the Treasury Department, or any other company or government entity. So to set the scene a little bit, the US federal government relies on the income tax to fund government. Social benefits are increasingly administered through the tax code. For instance, the Earned Income Tax Credit provides support for lower income workers, particularly those with children. There's the Child Tax Credit for individuals claiming dependents. And the Internal Revenue Service, or the IRS, is the federal agency that administers the income tax. And like other tax agencies, the IRS relies on audits to enforce the tax laws. And the core question we're going to spend some time on is, how do you do so fairly and effectively? The big challenge here is that over a kind of 10-year period, there have been really significant resource constraints on the IRS. Over a 10-year period, the IRS lost about a third of its auditors. The audit rate at that point of time dropped by around 42%, when the sort of best available evidence suggests that each enforcement dollar returns about $5 to $7 of increased tax collection, although there's some variance with some estimates pointing to returns that are actually an order of magnitude higher. The result has been that we've had a pretty significant tax gap. That is the difference between taxes owed and taxes paid. Commissioner Reddick went on the Hill to testify that the annual tax gap was approaching $1 trillion annually. At the same time, there's been a lot of questions about how to rebuild this sort of capacity of IRS. So in an op-ed in the Washington Post, the question was asked, well, why does the IRS need this kind of refunding? And in this op-ed, it said, well, just look at its cafeteria. If you enter the IRS cafeteria, it was described as a, quote, time warp with nearly 10 million unprocessed returns in July requiring manual data entry. So much of the kind of operational data system within the IRS still actually runs on legacy systems. So a quote from that Washington Post op-ed was, "See that green computer interface? It dates to the disco era. The system runs on COBOL." And so those are going to be some of the main questions. One of the main purposes of the reconciliation bill was to do forms of tech modernization to improve taxpayer services, but also a big chunk of that funding would go towards enforcement efforts. And so the question is, how do you do that well? There's a complex set of considerations in selecting who to audit for an entity like the IRS. One is that one of your core missions is obviously to collect revenue, which means that if you want to select audits, you should accurately identify those returns that have large adjustments or are likely to be subject to tax evasion, and also to select those returns to deter future misreporting. The second big objective is to learn more about noncompliance overall. There's actually a legal requirement for the IRS to estimate the overall tax gap, what we'll call the sort of population estimate of how much tax evasion there might be, and to actually improve the predictive model. And then third, there's a question of equity. How do you equitably allocate these kinds of enforcement resources, either along income or protected characteristics, which Jacob will talk about in a few minutes, poses a really significant challenge because IRS does not actually observe protected attributes such as race and ethnicity. And that's the kind of outline for the remainder of the talk. I'll spend a little bit of time talking about parts one of how to trade off these two first objectives, revenue and learning about noncompliance. And then Jacob will cover part two to really think about the equity dimension of all of this. So to turn to kind of part one, how you simultaneously maximize the reward, that is identifying places where people still have misreported and owe taxes, and learn about the overall tax gap. This is joint work with Peter Henderson, Ben Chug, Kristen Altenberger, Brandon Anderson, John Guyton, and Alex Turk. To give a little bit of background here, the basic process is that taxpayers file returns, which report income and claim benefits like the earned income tax or energy tax incentives. The IRS processes the return. That goes, at least in part, if it's not electronically filed, through that sort of manual process of data entry. Then there are automatic flags based on internal inconsistencies or math errors, mismatch to information reports, say from financial institutions or employers. Then each return receives a variety of risk scores that IRS has developed over time. And then based on that, the IRS selects which returns to audit, as well as how to perform the audit. There are audits that are simply done by correspondence, that is mail, ones that are done in the field with an examiner actually visiting taxpayers, and in the IRS field offices. The data we're going to use to really look at this set of questions is comprised of anonymized IRS tax returns and administrative records. We have information about the full universe of tax filers and operational audits, that is, those audits that were chosen based on one of these risk scores. Overall, the audit rate is about 0.5%. Then what we also have, and that a source of data that we're going to rely on a lot, is called the National Research Program, which was a stratified random sample of so-called research audits, which for the time period that we're talking about was about 13 to 16,000 random audits per year that are close to audited for line-by-line adjustments. And the time period we're looking at is around 2006 to 2014. And the historical kind of way in which selection for operational audits has been done is you take this random sample, you build some risk models, and then you have risk selected models based on this sort of risk model from the random sample. And what we prototyped first in this collaboration was really how to think about bringing together the information you have from the random sample to allow you to actually select audits to inform the risk model through active learning methods, and to ultimately enable you to unify what are these different audit selection streams so that you can, going forward, learn from simultaneously the audits that you've selected based on risk, as well as something that's closer to a random sample, since the risk selected audits actually tell you a lot more information since they're so much higher in volume. The big challenge then comes that IRS actually is required to report out a population estimate, which historically has been based on this particular random sample. So the key requirement here, which is a little bit different than a lot of the sort of conventional machine learning settings, is that we have an actual statutory requirement for unbiasedness of this population estimate. And so that poses some really interesting challenges, because if you think about a conventional way of taking a risk model, conventionally, we might choose some sort of a selection threshold, audit all of those that are above a kind of risk distribution. But we know from all sorts of literature that that kind of a greedy selection turns out to be biased. From the conventional NRP perspective, we would have random selection, which of course gives us an unbiased population estimate, but very low reward. And so it turns out there was not actually a kind of methodology that really allowed you to maintain unbiased population estimation and do this within this kind of an active learning framework. And so what we proposed in a paper is what we call adaptive bin sampling, which is essentially to smoothen, to enable IRS to control the amount of smoothing in terms of the risk selection. And so as long as you still maintain some positive probability of low risk returns being selected, you can bring in all of the insights of survey sampling and formally trade off reward and the precision of the population estimate, all while maintaining guarantees of unbiasedness by controlling the amount of smoothing. And we show in this paper that you can then really ride that trade-off very nicely. Here, plotting, for instance, the cumulative reward and the population estimate, the standard deviation of the population parameter. The really nice thing about this is that by bringing in active learning in this way, one estimate is that we can increase revenue by about 43% relative to baselines. We can reduce the variance of these kinds of population estimates. And we're really excited at this point to be working with IRS to explore the operational implications of this research. The last thing I'll mention before I turn it over to Jacob to talk about some of the equity dimensions is that we have another paper joint with Ben Chug and Peter Henderson, where we were really trying to solve this problem from a kind of optimization approach. And what you could write down is a kind of objective that tries to determine the selection probabilities for audit based on a combination of reward and the variance of the population parameter. What we show in that paper is that that's actually really intractable because it's not possible really to directly optimize variance, because joint inclusion probabilities of individual taxpayers become really intractable. But we borrow a page instead from the RL, the reinforcement learning literature, where entropy has conventionally been used to promote action diversity. But it turns out in this setting, you can actually also use entropy to give you unbiased population estimates too. So in the paper, we give some closed form solutions. And to us, it's been a really exciting direction to actually unify the optimal exploration and estimation literatures. And what we show is that for conventional estimators, we actually get really significant improvements. Here, again, is the reward on the x-axis and log of the variance on the y-axis, where the green and gray plots the frontier for ABS type approaches, and the blue and the yellow plot what happens when you actually use this kind of entropy regularization or Kullback-Leibler regularization. And we show that for kind of conventional estimators like inverse propensity weighting, doubly robust, or model-based estimates, you can get really significant advances based on entropy regularization type principles. What's really also exciting about this is that not only does it unify these sort of disparate literatures, it's also widely applicable in the public sector. In lots of government settings, just like the IRS faced this constraint, there are real requirements to simultaneously identify areas of risk while also providing unbiased estimates of population level compliance. like when the EPA does water quality sampling, or the Food and Drug Administration does food import testing, or as we show in another paper, testing policy for pandemic response. So we're really excited about this, but let me go ahead and turn it over to Jacob to talk about the sort of equity implications of this collaboration.
Thanks, Dan. And actually, I'm sort of going to suggest we deviate from format for 1 second, just because we're a little good on time. And I think the last question might be one that might be worth you might want to address while I'm sort of setting up. And I can read it for you if that's, I don't know if you have it in front of you.
I don't know if I have it in front of me. Feel free to read it.
Yeah. So how well would this research approach, this is Sean McAdams, travel to other contexts, especially more data poor developing countries, with more resource constraints? And if you want to sort of, the thing that comes to mind is both the higher income space. You might want to talk about a little as I'm setting up.
Yeah, sure. I think it's a really great question. Our hope actually has been to really develop some of the basic research here so that it really can travel to other contexts, particularly in label poor environments. IRS was, in a sense, in a very fortunate setting to have done years of this national research program with random sort of audit selection. And one of the questions for us that's been at the frontier is, how close can we get to forms of few-shot learning if we do much more work by learning embeddings, for instance, of all returns that are filed, or for op audits. So I think there's some really exciting directions there, and recent advances that have moved us much closer to kind of few-shot learning are really exciting to think about in this kind of a context of how you can allocate efficiently audits without necessarily having a really large set of labeled examples, because those are very costly. The line-by-line audits are neither fun for taxpayers nor motivating for a lot of examiners, because they're very resource intensive.
Okay, thanks, Dan. And I'm going to talk about the second stream of work, which is turning to really putting equity considerations front and center as we sort of employ more modern machine learning tools at IRS. Trying to think about guardrails to make sure that those don't reinforce existing sort of power inequities in society. And so this project is one example of that, focusing on audit allocations by race, specifically comparing Black and non-Black taxpayers. It's joint with Evelyn Smith, who is a grad student at Michigan in economics, Hedy El-Zain, who is a fellow at the Reg Lab, and then two Treasury employees, economists, Tom Hertz and Robin Fisher. So a big part of the motivation here is this interest that has been along for a long time and really gaining traction in recent years, thinking about how even facially neutral laws that don't, treat people differently by race end up, exacerbating sort of these existing inequities. And so, Dorothy Brown has a recent book on this, and a lot of this work has been focused on substantive tax provisions. So something like the mortgage interest deduction, which gives taxpayers a deduction when they, for mortgages of their homes. Well, we know that white taxpayers tend to have a lot more wealth, buy bigger homes, and benefit a lot more from this. Or, conversely, thinking about these dynamics, sort of substantive inequities for these provisions, these substantive provisions. Our focus, though, what's something that's really been missing and that you really need sort of like micro individual level to study, are thinking about tax administration. So how actually tax enforcement happens in the system. So that's one jumping off point. The second is, as in other contexts, the growing use of algorithmic tools and sort of modern machine learning methods can really help in a lot of government settings, right? Dan sort of talked about how audit selection is in large part a prediction problem, right? The IRS knows some features about a taxpayer and their characteristics and wants to predict, if they were to audit that taxpayer, how much underreporting would they detect? And the lesson we know from the algorithmic fairness literature is that, again, even if the algorithm is facially neutral, there's a risk of and ending up with unfair outcomes, sort of however defined, towards protected groups. This, I think a good example of this thinking and really sort of how prominent it's become is right at the start of the Biden administration, Executive Order 13985 instructed agencies to really look at whether there's policies and programs perpetuated systemic barriers for people of color. And but also in that executive order is sort of the key methodological barrier to doing that in an effective way, which is the second block of text, which is that in practice, in lots of settings we care about, including the IRS, we just don't have systematic data at the individual level by race. So, the IRS, when you fill out your 1040, your tax return, it doesn't ask you what your race is, unlike some other government forms. And the question that presents is, how do you do these sort of equity assessments, and how do you develop equity guardrails on algorithms when you don't have that type of data? So that's the jumping off point for our paper. And we sort of see our paper as making two types of contributions, one methodological and one more applied. So the methodological contribution is how do we think about assessing disparities when the protected characteristic you're worried about is unobserved? And so in our context, we're thinking about audits, and we want to make sure that they're not, that say Black taxpayers aren't being disproportionately selected for audit, but we don't know who is Black and who is not Black. So how do we think about that? And the solution we're going to propose is a partial identification framework. And what we mean by that is it's basically going to be bounds. We're not going to be able to tell you the exact difference in rates that Black and non-Black taxpayers face audits, but we'll give you some bounds, and we'll argue that in lots of settings in practice, the conditions under which those bounds work will hold, will be true, will be satisfied, and the bounds will be pretty informative. That's the methodological contribution. The substantive application, where we're also, I think, increasing our knowledge in this area, is help to understand how these algorithmic design choices and operational constraints shape inequities in audit selection in practice. So, tying back to sort of Dorothy Brown's work I referenced, a lot of this work so far has been focused on substantive tax law provisions. What we're doing is making progress on sort of the administrative tax administration enforcement side of things, and thinking about some of those in the weeds decisions, how those affect these broader policy goals. And so specifically, the two decisions we're going to focus on are the prediction outcome underlying the algorithm, and also various operational constraints that agencies like the IRS might face. And we're going to try to understand how those shape the trade-off between how effective the audits are at detecting underreporting on the one hand, and on the other hand, inducing various disparities, such as selecting Black taxpayers more frequently for audit. Now, something I'm not going to talk about, but just want to flag at the bottom here is some of our other related work. In addition to looking at race, we've also another sort of area that has raised a lot of policy concern is the audit in distribution by income. And so in some other work, we look at the, draw some sort of parallel lessons there. So just want to flag that work is out there in case folks are interested. Okay, so starting with the methodological question, like how do we actually understand disparities and measure how different policies affect disparities when we don't observe the characteristic that we're worried about? And so our starting point is what's known as BISG. It's sort of the most common method in the social sciences and government settings to try to impute race. When what you observe is say like the geography, the location someone lives, their neighborhood, and their last name. And the idea is that you take aggregated race data, say like, average race by neighborhood, and then average distribution of say last names by neighborhood, and you pool those together. And the key assumption here, and this is sort of a naive Bayesian method, in the sense that the assumption it's making for tractability is that the distribution, the relationship between names and race is sort of independent of geography and vice versa. So, it's a simplifying assumption, but makes the issue a lot more tractable. But the concern that raises is like, well, maybe the probabilities we're going to end up with are not actually right. And so, it's given rise to concerns when this has been applied in criticisms, like when is this a reliable method and when is it we're going to try to improve things in a couple ways. The first is that we're going to add first name, which is much less common here. But what previous research has shown is that if you're trying to identify Black individuals, first name adds a lot more information than just looking at last name alone. And we're going to implement this using aggregated data from sort of the normal sources that people use for this method. Okay, so one improvement I said is that we're going to sort of include first name, but the main improvement is this methodological sort of theoretical result, which is we're going to provide conditions under which we can interpret disparity estimates based on BIFSG scores as actually telling us about the true underlying disparity, right? So when are these, basically we're going to tell you the conditions that have to hold for our estimates based on these scores to actually give reliable results. And so, I'm going to abstract from most of the math here, but just a little bit of notation. We could think about an indicator for whether a taxpayer was audited. We could think of B, an indicator for their race. So 1 if they're Black, let's say 0 if they're not Black. 1 would indicate you're audited for Y. Y equals 0 would indicate you're not audited. There's some observable characteristics. In our context, it's going to be names and neighborhoods. But when you're thinking about this result, just pretend pretend Z is just neighborhood. It's a little easier to understand. And so the BI, in that case, would be the BIG score is the probability someone is Black based on what neighborhood they live in. What is that? It's just the average race, the average share of Black individuals in that neighborhood. That's how to think about that. That's going to vary sort of across like high Black and low Black density neighborhoods. And what is the parameter we're actually after? We're looking for the difference in audit rates by race, by whether somebody is Black or not. This should have a minus, not an equal sign. So this is basically saying the average audit rate if you're Black minus the average audit rate if you're not Black. That's what we're after. So we don't observe capital B. We don't observe self-reported race. All we observe is this proxy. How do we get there? So there's 2 approaches in the literature to get there, and I'm not going to go into all the math, but just at a high level, there's 2 things you might do. Like if you take a BISG score and you want to end up with a disparity estimate, like what might you do? Well, one thing you might do is you might take a weighted average of the audit rates for individuals and weight by the average that somebody is Black. So you take a bunch of individuals in the population, you look to see whether they're audited, whether they have a 1 for Y or a 0 for Y, and you take a weighted average, weighting more highly the ones that have a higher likelihood of being Black. What you get from that is the probabilistic disparity estimator. A second approach you might take that also I think is sort of reasonable for first principles is you might say, well, we don't know who's Black and who's not Black. But what we could do is we could just do a simple linear regression where we regress the probability that somebody is audited, that's the left-hand side variable, on the probability that they're Black, that's the right-hand side variable. And from that estimated slope, you could back out the difference in audit rates for somebody who is Black versus not Black. Both sort of ex ante reasonable. When's one going to work and when is the other going to work? The main useful methodological result from the paper is this theorem here. And what it tells us is that there's under 2 conditions, which I'll explain in a second, under 2 covariance conditions, then we're going to be able to interpret these 2 different estimators, the probabilistic and linear estimators, as bounds on the true disparity. So let me sort of step back and say that again, because there's a lot of math I'm sort of throwing at you. The idea is that you start with your BISG score, which you could estimate sort of off-the-shelf methods. And then you use that BISG score as an input into these 2 different estimators. You get 2 different numbers, and under certain assumptions, which I'll talk about in a second, those 2 different estimators are going to bound the true underlying disparity, the true difference in audit rates by race. Okay, so what are those assumptions? The first is about the covariance between, they're both conditional covariance terms. So the first is about whether Black taxpayers are more likely to be selected for audit, conditional on their estimated probability of being Black. So again, imagine that we're estimating somebody's probability of being Black solely based on their neighborhood. What does this condition require? It would say that even looking within, taking people from the same neighborhood the Black taxpayers living in that neighborhood would be more likely to be audited than the non-Black taxpayers living in that neighborhood. So we think that's going to hold in the setting. Well, I'll come back to that in a moment. But what's the second condition? The second condition is that it's another conditional covariance condition. There should be a covariance term here. Apologies. And what that term is saying is that the covariance between whether somebody is audited and their estimated race should be positive even after we condition on their actual self-reported race. So what does that mean? That's saying if you just take Black taxpayers and you compare Black taxpayers living in neighborhoods with lots of Black taxpayers and compare that to Black taxpayers living in neighborhoods with fewer Black taxpayers, the ones living in neighborhoods with lots of Black taxpayers are facing a higher audit rate on average. And again, that's going to vary by case. We think, we point to some theoretical reasons why we think that would be true here. And when those conditions are hold, then we can interpret this as bounds, as bounding the true disparity. Okay, so how do we know whether these are true or not? I'm not going to show you those results here. They're not quite cleared. But what we do is we match a subset of our data, our tax data, to publicly available voter registration records from the state of North Carolina, which until recently was required to report the race of individuals who registered to vote. And from that matched data set, we could actually evaluate these conditions empirically. And what we find is that they're satisfied in that sample. So as long as you believe North Carolina is sufficiently like the rest of the country, it's pretty strong evidence that our bounds are going to hold in this setting. And you could do the normal things like adjust for observable differences between North Carolina and the rest of the country, and it's pretty robust. Okay, so that's the methodological contribution. What does this stuff actually look like in practice? When you estimate BISG scores, we get a distribution, and the striking feature is that it's bimodal, right? There's a lot of people for whom we're very confident they're not Black, and then there's another set of people whom we're pretty confident they are Black, with relatively fewer people in between. Now, what about when we use our North Carolina match data for the ones we have it for, and we compare on the x-axis the predicted probability they're Black against the true probability that they're Black based on their self-reported race? If it was a perfect prediction, it would exactly follow the 45-degree line. That's the dashed line here. What you see sort of for the overall population is which is the blue line, it hews pretty closely. And when we look at various subpopulations of taxpayers, it looks like we're undershooting a little bit, but overall it's a pretty tight relationship. And we do some extra analysis in the paper to sort of calibrate it further if you're worried about these sort of deviations from the 45-degree line in our setting. Okay, so that's all by way of methodological, trying to get at this question, like how do we assess disparity when we don't actually observe race? The next set of results basically treats that problem as solved, and it basically tries to understand how different choices in operational decisions the IRS can make, or sort of algorithmic design decisions the IRS can make, how those type of decisions affect the effectiveness of the audits in terms of detecting revenue, but also the disparity that those audits induce. And so how do we look at this? Our basic approach is to train supervised learning methods. We're going to focus mostly on random forest models, and we're going to use them to predict underreporting. So, again, audits are basically like a prediction problem from the IRS's perspective, right? We're going to use the random audit data that Dan talked about from the NRP to train those models. We're going to focus on not all taxpayers for this purpose, but only EITC claimants, people who are claiming the earned income tax credit. That's a credit. It's the sort of biggest refundable credit in the tax code, sort of the biggest way in the US we do social, let's say income transfers. The reason why that's a really interesting population to look at here is it's more diverse than the average population, but it's also the site of a lot of audits. So Dan mentioned the overall audit rate in the US in recent years is about 0.5 percentage point. For EITC claimants, it's about 3 times that. It's about 1.5%. So, we really want to learn about disparities in this setting. Okay, so what do? We train these models on NRP audits to try to predict underreporting. And specifically, we're trying to optimize on two different characteristics. We sort of compare these approaches. So the first type is a classifier, where what we're trying to do is train the model to predict the binary outcome of whether the taxpayer underreported at least $100. The second type of model we look at is a regressor model, where the outcome we're trying to predict is continuous, right? Just the total dollars amount of underreporting. And we're going to compare those two different types of models. What goes into the models? Basically, all the stuff that the IRS observes. Everything that you report on your tax return, all the administrative data that they have. We're sort of limited on what we can sort of publicly disclose about that. But that's all sort of wrapped up into as a potential features for these models. And our plan is that we sort of run these various models, we train them, and then using a holdout subset of the NRP, we see how they perform in terms of detecting adjustments, and we evaluate the bounds on how much disparity they induce. So again, just the thing to emphasize, these are not actual IRS models. We don't know what those models are, right? These are simulations that we're running based on real IRS data to try to get a handle on these things. Okay. So the first set of results on the classifier model, the x-axis shows us how much underreporting we detect. The y-axis shows us the degree to which Black taxpayers are audited at higher rates. As you move along this line, it's a trajectory based on differences in how many returns are audited, looking from 0 to 3%. The status quo audit rate for this population is right in the middle, about 1.5%. And what you see is very consistently that Black taxpayers are selected at higher rates than non-Black taxpayers if you use a classifier model. What if we contrast that to the regressor model? Well, now we see a very different picture, right? If the objective is now to maximize the total amount of detected underreporting, you not only find more underreporting, not surprisingly, you also now actually select non-Black taxpayers at higher rates than Black taxpayers. So whereas like lots of the algorithmic fairness literature is focusing on like sort of features inducing various biases, right? One finding that we have here is that it's actually the label, whether we think about this as predicting the binary outcome or sort of the amount total, the continuous outcome that's driving a difference in who's selected. As a benchmark, sort of which is reasonable, we could compare both of these to an oracle, where sort of counterfactually, we pretend that we actually know the true amount of underreporting for every single person. That's not, of course, what the IRS could actually observe, but just pretend that they have it. And we rank people according to that, selecting, say, like the top 1% for audit or the top 2% for audit, and so forth. And what you see there is something that matches more closely to the regressor, right? It finds more underreporting, not surprisingly, but also it's selecting non-Black taxpayers at higher rates than Black taxpayers. So that's one finding that emerges here. The classifier, to the extent that the tax authority relies on a classifier model, that might tend to select Black taxpayers at higher rates. What drives that? I don't have time to get into this too fully, but the upshot is that we could decompose the classifier induced disparity into various components. And the biggest one is differences in sensitivity between Black and non-Black taxpayers. What does that mean? So if you're Black and you are non-compliant, you are much more likely to be detected or selected by the algorithm than if you are not Black. So, one way to interpret this, and as sort of talking to IRS employees about this, one phrase that gets sort of thrown around is like shooting fish in a barrel, right? It's the type of mistakes that Black taxpayers are making tend to be lower in magnitude than non-Black taxpayers, but they tend to be ones that are easier to detect by the classifier. The very last point I'll make before I end is turning from questions of algorithmic design to sort of operational or resource type constraints that might shape this decision. And so far we've sort of treated all audits as having the same budgetary or examiner resource costs to the IRS, but in practice, audits are very heterogeneous with respect to how hard they are for the IRS to perform, right? It's a lot easier to audit an individual claiming the EITC than it is to audit, a really high income person with like many business partnership returns. And it could be that some allocations coming out of these simple algorithms might not actually be feasible, or they just might be too expensive. And so to get a handle on that, we sort of focus on two different types of EITC returns, basically dividing taxpayers who had business income versus those who didn't have business income. And the ones with business income, it's a lot harder to audit. So we ask, what if the IRS is constrained to focus on business returns in the existing degree to which they currently do, and non-business returns to the degree they currently do? Do our sort of results carry through to that setting? And what we find is that they do. So this is plotting again at sort of the status quo audit rate, the disparity and revenue induced by the classifier, the regressor, and the oracle when it's unconstrained. So this is sort of what I showed you before. And what about when we impose these various types of constraints? Not surprisingly, it moves to the left, right? That's telling us that we do a worse job of collecting revenue. That's not surprising. But equally notable and really consistent finding is that we're also moving up, right? Each of these, when we impose these constraints, we're auditing Black taxpayers at a higher rate than we were doing otherwise. So, bottom line takeaway here is that these two different dimensions we've identified are both choice points as you're thinking about how you sort of want to deploy enforcement resources that really shape the degree to which Black taxpayers are audited at higher or lower rates than other taxpayers. So Dan, I'll turn it back over to you to conclude.
Great. Thanks. Just a couple of takeaway points, and then we'll open it up for questions. There are these two kind of core IRS problems that I think we've illustrated trying to address here. One is how to collect revenue and maintain unbiased population estimation as you turn towards more advanced forms of AI. And then the second is really a framework under the executive order 13985 for doing these kinds of equity impact assessments when government agencies under the Privacy Act of 1974 are in this very challenging position of being mandated to conduct these kinds of assessments when they lack, as most of algorithmic fairness assumes, access to a kind of binary protected attribute. Second is that the public sector, as we've shown you, really poses some really unique methodological challenges that don't allow you to simply take off-the-shelf solutions that have been developed in the pure ML literature to solve these kinds of things. The first example from the first part of the talk is the statutory prohibition on writing the bias variance trade-off in the way that a lot of conventional ML might think about addressing kind of population estimation. There's a requirement of unbiasedness. And then the second is that contrary to what most of algorithmic fairness assumes, the Privacy Act of 1974 means that there are actually often many agencies that lack direct access to protected attributes. And so you have to think about a framework of actually doing algorithmic fairness given that major constraint. We'd argue that the margin of improvement here is very high relative to, say, improving by 1% the F1 score on a click-through rate for online advertisements, because there's literally nothing less at stake than funding all of government. So regardless of which area you care about, there are many agencies that really rely on revenue collection to fund mission-critical things. And then fourth, I think one of the really interesting lessons, as Jacob just spelled out, is that off-the-shelf kind of algorithmic fairness approaches that impose a definition and then move towards a kind of constrained optimization approach to meet, say, equalized odds or whatnot. Really, I think the next generation of work is going to require being much more institutionally engaged to look at the sources of disparity. Jacob, I think, spelled out really nicely what happens when you, and the kind of radically different implications you get based on an understanding of the sources of disparity. One version of it is it's the model objective. So fix the algorithm and move from classification to regression. Another that Jacob just highlighted is that this is actually about agency constraints. you saw that once you impose that constraint on examiners that are able to actually examine business income, everything kind of shifted. And the implication there in terms of fairness is very different, which is that you need more funding for specialized examiners, which are exactly the kinds of examiners that left over the period of 10 years when about a third of examiners left the agency. The other is that part of what we're observing here is disparities in information. And then the policy implication that would follow is not just an off-the-shelf algorithmic fix, but maybe really a mandate for improved information reporting where you're learning insufficient amounts about taxpayers. And so for us, what's really exciting about this is we've had a ton of amazing collaborators in this project. And for us, it really points toward what happens when AI moves into real world settings where we need these kinds of private, public, collaborative, and interdisciplinary models to really develop a framework for how to do responsible, safe, and effective AI innovation cycles within the public sector. Last, I want to just give a real note of appreciation, Jacob, if you go to the last slide, for the support that we've gotten from the Hoffman E grant, as well as Arnold Ventures, really to support this kind of work. So with that, let's go ahead and open it up for questions. So we have a number of questions in the chat. Maybe I'll start off with one I think asked by Jim Salzman, which is a question really about kind of the sort of optimization objective. So Jim Salzman asks, is it possible to simultaneously optimize merit, equity, diversity, and return on enforcement effort, which is, I think, is a really nice way of thinking about the complex kind of trade-offs that IRS is drawing. Jacob, do you want to take a crack at that?
Yeah, I think that is exactly the right way to think about these sort of things is how do we sort of put all these in a unified framework. You know, one way to think about return on enforcement effort is like the return, right, is like what is the cost to the agency. I think an important input into the model is the cost to the taxpayer as well of being audited. Like, for example, when an EITC claimant is audited, usually their refund is frozen while the IRS looks into it, which can take, you know, months and you know, cause people to sort of take out other sort of forms of high interest loans. Equity for sure along sort of both income distributions and other directions. You know, like race in our context that we looked at, and then finally like deterrence effects, right? Like, so not just like the direct amount of revenue selected on audit, but also thinking about like how is this going to change taxpayers' behavior going forward to make them more likely to voluntarily choose to comply. And so thinking about the right framework to put all those pieces together is sort of an area of ongoing research for us and our research team.
Yeah, I mean, we've shown you how hard it is just to think about unbiased population estimation as well as revenue maximization. And obviously, this is a kind of complex sort of set of objectives. I'll just add a couple of others to this. One is that if you just think about the classification versus regression choice, the choice of label, one of the things when you move this into a complex organization with thousands of examiners, one of the things that has been top of mind for some of the units within IRS is also sort of the morale of the examiners themselves. They actually get frustrated having to examine taxpayer returns that have no adjustments at all. And so that's why at least some think that should push in favor of a model that at least does some form of classification, although that comes, as we show in the work, with a pretty significant kind of trade-off. I'll add one other thing to this, which is at one point we were engaging with a number of folks who were really trying to spell out the performance objectives. And I think what we arrived at was like a 300 plus dimensional kind of performance set. And it's obviously really hard to ride the Pareto frontier over that many different objectives. And that, I think, is what is really quite distinct from, when you think of kind of conventional ML benchmarks that just have a single kind of task. Government agencies are faced with a really wide range of stakeholders and many things that they have to address. And so I think that actually makes for very interesting forms of machine learning. So we've got another question here by Sean. So Sean asks a question that is really going to this kind of race measurement and disparity estimation. And there are a couple of other sort of questions that speak to this. And really, there are two components to Sean's question. One is, how do you think about the performance of these estimates by different subgroups? It seems like a really large single subgroup that we focused on here. And then the other is the interaction with wealth. Jacob, do you want to start and take a crack at that? I'm happy to jump in on that as well.
I think maybe you should go ahead on that, because I think it ties into some of the conversations we've been having on like the AFC work, maybe.
Sure. Yeah, I think the question is a really fantastic one that has been subject to much criticism. Basically, within federal government, the Office of Management and Budget issued a directive in 1997 that set the standard for all federal agencies of how to actually sort of measure self-reported race when it is reported, with 5 kind of main categories. That's a really dated standard from 1997, and the chief statistician at OMB really is engaged in a process right now of thinking about how we move beyond that form of measurement and engage in more disaggregation by subgroups. Within the Asian American community, that has been a big question. So for instance, if you, in a different domain, if you look at health outcomes within Santa Clara County in the pandemic, Asian Americans as a whole look like they're doing really well in terms of case infection rates, vaccination rates. The moment you disaggregate by subgroups, it actually turns out there's some Asian American subgroups, like Vietnamese Americans. There's a large Vietnamese American population within Santa Clara County that actually look like they're suffering much more during the pandemic. And so that's been the critique, for instance, within the Asian American community, to really engage in more forms of data disaggregation, which I think is a really interesting way forward. I also think that forms of the kinds of methods that we've prototyped here can potentially help to get you there. The really tricky position that most federal agencies are left with under the Executive Order 13985, which mandates these equity impact assessments, is you've kind of got 3 options. One is you can change your form and ask people. IRS was very reluctant to do that because of the perceptions that might create amongst taxpayers. You could link to other federal records. That's a really tricky thing under the Privacy Act of 1974. Or you could engage in the kinds of imputation methods that Jacob covered during his portion of the talk. And we think there's some really interesting potential ways to actually do that as well, using other microdata to do exactly the kind of disaggregation that Sean asks about. But Jacob, do you want to add anything to that?
No, I thought that was great. I'm happy to jump to, there's another one by KP that's, asking how should the IRS be thinking about drawing trade-offs between fairness and efficiency? And I think I think actually the reply, another Jim Salzman contribution, is nice here, that it's not established that trade-offs are necessary. And I think we went into it really thinking, like, what will this trade-off be? Like, can we trace out this sort of Pareto frontier on this? And really the lesson that emerges, I think, is that, like, it really depends on how you define efficiency, right? Like, what is the objective? So if your objective is maximizing the total amount of underreporting, and we're thinking about detection of underreporting, and we're thinking about fairness as avoiding selecting a historically marginalized group at higher rates, right? Basically worried about selecting Black taxpayers at higher rates than non-Black taxpayers. There's not really a trade-off that we're seeing in our setting between those two goals, right? Like, when you look at the Oracle, which is the best sort of version of efficiency, it's not selecting Black taxpayers at higher rates, And it's when you move to a different objective, like the classifier, that you do start to see that. So it really, I think, when you're starting to think about different margins that affect fairness, it sort of forces a conversation as to like what your metric underlying efficiency really is, and sort of, is outside of the scope of a lot of the algorithmic fairness literature so far.
Jacob, there's a clarification question here by Clay Thompson that might be worth tacking on here, which is just the justification for the bounds. Why are we doing these bounds at all? Why would it make sense? And I guess this is part of the interesting part of this quote, even when there is no racism. Maybe do you want to take a crack at just why the bounds are an important thing to think about? And then I can talk a little bit about some of the questions that are at the forefront, really, of civil rights law between, disparate treatment and disparate impact.
Yeah, well, I'm not sure about the no racism aspect. I think I'm missing something there, but methodological justification for the bounds is important. We think even when you have a facially neutral algorithm that doesn't take race as an input, and maybe I should make that clear, right? So there's, we're not really concerned about disparate treatment for EITC audit selection in this setting, right? It's pretty much all automated, and IRS doesn't observe race. So we're not worried that sort of observationally identical taxpayers to the IRS are being selected at different rates based on whether they're Black or non-Black. Right? The concern is much more of a disparate impact style concern, which is that we're, even if there's sort of a facially neutral algorithm, we might end up sort of selecting Black taxpayers at much higher rates than non-Black taxpayers for reasons that are unrelated to the sort of actual objective of the algorithm. And so the point of the bounds is that we don't actually observe self-reported race in this setting. How could we assess that sort of question? And we can't get an exact answer, like one number, with the type of data we have, but we think under these assumptions, which seem credible to us, and we have evidence that they hold in the setting, with the bounds, what they let us do is basically say that disparity is between some sort of measure. So I showed you in the slides sort of a lower bound, more conservative estimate for what the disparity is. You could do the same thing applying the upper bound, and you get sort of an implied disparity twice as high, but like the qualitative patterns are pretty similar. So that's the purpose of the bounds.
Yeah, maybe I can just add to that, because I think it is this, you're quite right, Jacob, to think about this in terms of disparate impact. So anti-discrimination law has conventionally thought about intentional discrimination versus disparate impact being a facially neutral policy that has adverse effects on some subgroups. And I think this has been a really interesting tension. We just had nearly 4 hours of oral argument in the affirmative action cases on Monday, where there's this very sharp tension between the trajectory of where anti-discrimination law has been going and where algorithmic fairness has been going. The latter has been primarily anchored around notions of disparate impact, and anti-discrimination law has increasingly been moving towards a form of blindness, when what we've learned from the better part of a decade of algorithmic fairness research is that there's no fairness without awareness. So even when IRS does not itself have these kinds of protected attributes, there are real concerns, and that's the reason for the executive order, to try to understand what neutral processes could still be generating disparate impact. And let me give you one example of that just to make that concrete. A lot of EITC audits happen through mail. And one of the things that happens if you don't respond to mail, you're seen to essentially forfeit on the claim. And we know that there are pretty sharply different mobility characteristics across subgroups. And so those are the kinds of things that one worries about and could lead to policy changes to mitigate that form of disparate impact. But the only way to get there is to have some level of awareness, and the bounds really help to get you there in a credible way. I'm afraid that is, we are close to time. So thanks so much for all the wide-ranging set of questions. And we're really, it was terrific to get that level of engagement. Thank you, everyone. Our seminars, the HI seminars, will be on hold for a few weeks due to other HI events and the Thanksgiving holiday. The next seminar will be on November 30th with Lindsay Felt, discussing art AI and disability futures. And let me give a big shout out to the HI team here who has helped to organize this. That's Madeline Wright, Casey Peel, and Vanessa Parley. Thank you so much for helping us organize this event, and we'll hope to see you all after the break.